All right, so now that we've talked about how we use monetary policies to combat recessionary gaps, remember those recessionary gaps is when the equilibrium of a nation's product market is below full employment. Now that we've talked about that, we're going to now dive into combating inflationary gaps. And as you could probably guess, it's going to be just exactly the opposite. Because we know that an inflationary gap is whenever the nation's product market equilibrium is actually higher than the nation's full employment. It's greater than the nation's full employment. So what that means is the equilibrium of the national product market is over the nation's full employment. So it's actually causing a lot of inflation at that point, and for simple reasons. Well, if we are beyond full employment, then people are working more, and if they're working more than what they're wanting to do, they're demanding to be paid more. If they're demanding to be paid more, then they make more money. If they're making more money, they're spending more money, and it causes these inflationary prices. And these inflationary prices actually outweigh the increased production. So we don't necessarily want an inflationary gap. We don't really want an inflationary economy because prices are going up faster than what we're producing goods at. So how do we get rid of that inflationary gap? Well, we're actually going to use contractionary monetary policies to combat this inflation. We're actually purposely trying to slow down the economy. So how are we going to do that? Well, we're going to use those three monetary policies set forth by the Fed. And essentially, we're going to try and lower the money supply. We're going to try and raise the interest rate. We're going to try and lower the credit available to the consumers and producers. We're trying to make it more or cost more for them to take out loans. We're trying to reduce the availability of loans, the availability of this credit, trying to lower the money supply to where they don't have as much money to spend, basically. Well, how is that going to be accomplished? Well, we're going to try and lower the money supply by selling governmental securities. Whenever the Fed is selling governmental securities, remember that's money that's leaving the individual's checking account, and it's decreasing the amount of reserves. They're going to also be trying to raise the discount rate. That's going to decrease the amount of reserves that a bank is going to be willing to loan out. And we're also going to try to raise the required reserve ratio, and that's going to decrease that money multiplier. Essentially, what we're going to be trying to do in each one of these is impose these contractionary monetary policies in order to lower the money supply, raise those interest rates, and lower the credit available to consumers. So all of these all lead to decreased money supply, less reserves, and less reserves that are used for loans. Decreased loans decreases the credit availability and increases those interest rates. It's going to reduce consumption and investment expenditures. If the loans cost more because of the increased interest rates and it's harder to get a loan, we're going to find that people aren't going to invest as much. It's going to be harder to invest because it's going to cost more to invest, making them not want to invest. So if they're not going to invest, then that's actually going to decrease that total amount of consumption. And we're going to try and reduce that consumption by reducing the amount of money that's actually out there in the money supply, and as well as increase interest rates and reduce the availability of loans to households as well. So what does that do? What does all of this do? Well, it puts downward pressure on the price level. It's going to reduce the inflation, and it's going to reduce, or it's actually not reducing unemployment, but actually increasing unemployment. It's reducing employment. So I forgot to take off the un part, but it's actually going to be starting to reduce employment overall. So how does this work? So assume that the aggregate demand in the economy is currently at AD5. We're currently out here in this inflationary aspect. We are above, our economy is the equilibrium is above this full employment. So if it's above that full employment, we are in that inflationary gap area. Remember in the last video, we talked that whenever P5 was way up here, the prices, we have way inflated prices and not that much gain in output. So we are going to try and reduce those inflated prices. And we're going to do that by lowering that money supply, raising the interest rates, and lowering that credit available to consumers and producers. So we're going to do that through those contractionary monetary policies. The Fed is going to engage in those contractionary monetary policies. These three contractionary monetary policies. And by doing that, they're actually going to shift this aggregate demand curve from AD5 to AD4. Well, what does that do? Well, that forces prices to fall. And how does this work? Well, if people aren't demanding as many products, then they're not going to be producing as much. If they're not producing as much, they're not making as much money. If they're not making as much money, they don't have as much money to spend. And by that, we're going to be actually decreasing the prices of our goods. So we shifted aggregate demand curve from AD5 to AD4. Prices are going to fall from P5 to P4. So we see prices fall, and then output falls from Y potential to YFE. So the key thing to note here is that prices, there's a significant drop in prices as we go from P5 to P4, but there is not a significant reduction in output. Our output actually changes very little, but yet our prices drop a lot. So we're able to offset a large reduction in prices, or a large price increase, by just a little bit of a drop in output. So this is not a significant reduction. But what if we continued to employ this policy? What if we continued to employ these contractionary monetary policies after we hit this full employment aspect? Well, if we do it again, we kind of shut down the economy again. We actually move from AD4 to AD3. And as we shift to AD3, we see that prices fall again, but then our output falls as well. And we are no longer operating at full employment. That's not where we necessarily want to be. We want to be at full employment. So what happens is that the Fed will be using both contractionary and expansionary policies at various times to trying to keep the economy fairly level. So let's say that they try these expansionary policies, and the expansionary policies actually shifts that aggregate demand curve beyond full employment. Well, then they're going to try and impose these recessionary or these contractionary monetary policies, and we're going to shift it back. But sometimes we overshoot, so then we shoot way back here. So then they're going to try and correct it again by using expansionary monetary policies, and we're trying to shoot for this full employment. We're trying to operate there. Because in all reality, we want the economy running at full employment, because whenever we're at full employment, we have a large amount of output without really severely inflated prices. So that's where we are trying to shoot for.